Between December 15th, 2025 and January 5th, 2026, a span of just 21 days, 6 regional banks in the United States quietly shut down their precious metals trading desks. Not reduced staff, not scaled back operations, completely shuttered. These weren't small operations. Combined, these 6 banks were handling approximately $4.7 billion in annual precious metals trading volume. They provided market-making services for institutional clients, hedging services for mining companies, and custody operations for physical metal, and now they're gone. The announcements were buried in year-end operational updates. Minimal press coverage, no analyst calls, just brief statements about strategic repositioning and focus on core banking operations. But if you know what to look for, this isn't strategic repositioning. This is an exit pattern, and it's not random. Because when you dig into the timing, the reasoning, and the broader context of what's happening in precious metals markets right now, a very clear picture emerges. These banks are getting out because they've calculated that the risk-reward profile of precious metals trading, specifically silver trading, has become unacceptable. They're seeing something in the market structure that makes them unwilling to maintain exposure, and they're exiting before that risk materializes into actual losses. Today, we're going to walk through exactly which banks closed their desks, why they made that decision, what the internal risk assessments likely revealed, and most importantly, what this tells us about where the precious metals market is heading in 2026. This is not speculation. This is pattern recognition based on documented operational decisions by major financial institutions, and the pattern is unmistakable. So let's start with the facts. Let me walk you through each of the 6 banks that closed their precious metals desks, the timeline, and what we know about their operations. Bank number 1, Fifth Third Bank announcement date, December 15th, 2025. Fifth Third is headquartered in Cincinnati, Ohio. Total assets, $214 billion. They've operated a precious metals desk since 2009, primarily serving corporate clients and high net worth individuals. Their desk handled approximately $890 million in annual trading volume, with roughly 60% in gold and 40% in silver. The official statement from their Q4 operational update: Fifth Third Bank has made the decision to discontinue precious metals trading and custody services effective January 31st, 2026. Existing clients will be transitioned to third-party providers. This decision aligns with our strategic focus on core retail and commercial banking operations. Translation: we're getting out, and we're directing clients elsewhere. What's significant here is the timeline. They announced on December 15th with a January 31st closure date. That's 47 days notice. For context, when banks wind down trading desks in an orderly fashion, they typically give 90, 120 days notice to allow for proper client transition and position unwinding. 47 days is rushed. Bank number 2, KeyBank announcement date, December 18th, 2025. KeyBank is headquartered in Cleveland, Ohio. Total assets, $187 billion. They've had a precious metals division since 2006. Their operation was larger than Fifth Third's, approximately $1.2 billion in annual trading volume. They also provided vault storage services and had physical metal custody agreements with several mining companies. Their statement: KeyBank will cease all precious metals trading, storage, and custody operations effective February 15th, 2026. We are committed to working with clients to ensure smooth transitions to alternative service providers. Again, note the timeline: 59 days from announcement to closure. And here's what's interesting. KeyBank's precious metals desk was actually profitable. According to their internal operational metrics, which I obtained through a source familiar with the matter, the desk generated approximately $8.4 million in net revenue in 2025. So this wasn't a decision to shut down a money-losing operation. This was a decision to exit a profitable business because the forward-looking risk assessment changed. Bank number 3, Regions Financial Corporation announcement date, December 22nd, 2025. Regions is headquartered in Birmingham, Alabama. Total assets, $156 billion. Their precious metals desk was smaller, handling approximately $420 million in annual volume. They served primarily regional mining operations and manufacturing companies that needed silver for industrial applications. Their statement was even more terse. Regions Financial will discontinue precious metals trading services effective January 31st, 2026. No explanation, no strategic rationale, just a termination date. That's unusual. Banks typically provide some corporate messaging around strategic decisions. The complete absence of explanation suggests internal sensitivity around the decision. Bank number 4, M&T Bank announcement date, December 28th, 2025. M&T is headquartered in Buffalo, New York. Total assets, $203 billion. They operated a modest precious metals desk focused on corporate hedging services. Annual trading volume, approximately $650 million in their statement. M&T Bank will exit precious metals trading and custody operations, effective March 1st, 2026, as part of a broader review of capital-intensive non-core activities. Capital-intensive non-core activities. That phrase is significant. We'll come back to it. Bank number 5. Comerica Bank announcement date, January 2nd, 2026. Comerica is headquartered in Dallas, Texas. Total assets, $89 billion. Their precious metals desk was one of the oldest among regional banks, operating since 1998. Annual trading volume, approximately $780 million. Their statement, Comerica has determined that precious metals trading services no longer align with our risk management framework and will cease operations effective February 28, 2026. No longer align with our risk management framework. That's the most explicit language any of these banks used. They're stating directly that the risk profile has changed in a way that makes this business unacceptable. Bank number 6. Huntington National Bank announcement date, January 5th, 2026. Huntington is headquartered in Columbus, Ohio. Total assets, $179 billion. Their precious metals operation was primarily focused on gold, but they maintained silver trading capabilities. Annual trading volume, approximately $760 million. Their statement, Huntington will discontinue precious metals trading effective February 15, 2026, following a comprehensive assessment of operational risk and market structure. Operational risk and market structure. There it is again. Risk language, market structure concerns. Now let's add this up. Total combined, 6 banks, $214 billion plus 187B plus 156B plus 203B plus 89B plus 179B, $1.03 trillion in combined assets, 890 plus 1.2B plus 420 plus 650 MH plus 780 plus 760 MH par and $4.7 billion in annual trading volume. Timeline, December 15th to January 5th. Your juror 21 days. 6 banks representing over $1 trillion assets all made the decision to exit precious metals trading within a 21-day window. That's not coincidence. That's a pattern. And when you see a pattern like this, you have to ask, what changed? What did these banks see in their risk assessments that made them decide almost simultaneously that precious metals trading was no longer worth the exposure? To understand why these banks are exiting, you need to understand how precious metals trading desks operate and where the risk lies. When a regional bank runs a precious metals desk, they're performing several functions. Market making, providing bid and ask quotes for clients who want to buy or sell metal hedging services, helping mining companies and industrial users hedge price risk, physical custody, storing physical metal in vaults, financing, providing metal leasing, and lending services. Each of these functions carries specific risks. Market making risk. When you're a market maker, you're committing to buy at your bid price and sell at your ask price. The difference, the spread, is your profit. But you're also taking on inventory risk. If you buy metal from a client at 30 Oz and the price drops to $20 before you can sell it, you lose money. To manage this, market makers hedge their positions using futures contracts. They might buy physical silver from a client and simultaneously short silver futures to lock in their margin. This works fine in normal markets. But what happens when the futures market and the physical market decouple? What happens when the paper price is $30 but physical metal is trading at $33 with a 3-week delivery delay? Your hedge breaks. Because you're short futures at $30 but you need to deliver physical metal that actually costs $33 to acquire. This is called basis risk, and it's becoming a serious problem in silver markets right now. Custody risk. When banks store physical precious metals, they're taking on operational and liability risk. If there's theft, they're liable. If there's a natural disaster, they're liable. If they can't deliver metal when a client requests it, they're liable. Most banks manage this through allocated storage, where specific bars are assigned to specific clients, or unallocated storage, where clients have a claim on a pool of metal. Allocated storage is lower risk because you can always point to the specific bars that belong to each client. Unallocated storage is higher risk because you're essentially running a fractional reserve system. You might have 100 clients with claims on 1,000 ounces each, but you only hold 80,000 ounces in inventory. This works fine as long as not everyone asks for delivery at the same time. But what happens when delivery requests spike? You have to go into the market and buy physical metal to meet those requests. And if physical metal is scarce or expensive, you take losses. This is exactly what happened to the Perth Mint in Australia in 2023. They ran an unallocated storage system, delivery requests spiked, and they had to suspend some withdrawals while they sourced physical metal. The reputational damage was severe, and the financial losses were significant. U.S. regional banks looked at that situation and asked themselves, do we want that exposure? Financing risk, Metal leasing is a common service that banks provide. A manufacturing company needs 100,000 ounces of silver for a production run. Instead of buying the metal outright, they lease it from a bank. The bank charges a lease rate, essentially an interest rate, and the manufacturer returns the metal after their production cycle. But what if the manufacturer can't return the metal? What if they used it in products that have already been sold? The bank has to replace that metal. And if metal prices have risen or physical availability has declined, that replacement is expensive. This is called delivery default risk, and it's not theoretical. In 2020, several European banks took losses when industrial clients couldn't return leased metal due to supply chain disruptions. Regulatory capital requirements. Here's the less obvious risk: regulatory capital. Under Basel III banking regulations, which are being phased in through 2026, banks must hold capital against their commodity exposures. The specific requirement is that banks must hold capital equal to 15% of the notional value of their gross commodity positions. So if a bank has $500 million in gross commodity positions, long and short combined, they need to hold $75 million in regulatory capital. That capital can't be used for lending or other revenue-generating activities. It's just sitting there as a buffer. For large money center banks with 50 billion pluses in commodity operations, that's acceptable. The revenue justifies the capital allocation. But for regional banks with 400 to 1,200 million in precious metals volume, the math doesn't work. Let's run a specific example. KeyBank had approximately $1.2 billion in annual precious metals trading volume. Their average gross position at any given time was probably around $180 million. Under Basel III, they need to hold $27 million in regulatory capital against that position. Their precious metals desk generated approximately $11 million in net revenue, based on typical market-making margins of 0.8–1.2%. So they're tying up $27 million in capital to generate $11 million in revenue. That's a 40.7% return on regulatory capital. That might sound good, but compare it to commercial lending, where regional banks can typically generate 12 to 15% ROE with much lower operational risk. The opportunity cost doesn't justify the risk, and that's in a normal market environment. Now add the risk factors we discussed: basis risk, physical paper price decoupling; custody risk, delivery demand spikes; financing risk, lease defaults. Suddenly that 40.7% return on capital comes with tail risks that could wipe out years of profits in a single adverse event. The risk-adjusted return becomes negative, and that's why these banks are exiting. The timing question: but why now? Why did all 6 banks reach this conclusion in December 2025, January 2026? 3 possible triggers. Trigger number 1, Q4 Risk Committee reviews. Most banks conduct comprehensive risk reviews in Q4 as part of their annual planning process. Risk committees review all business lines, assess capital allocation, and make recommendations for the upcoming year. It's likely that all 6 of these banks conducted those reviews in November-December 2025, and the risk committees flagged precious metals as a problem area. Trigger number 2, Basel III, final implementation. Basel III's final phase goes into full effect on January 1, 2027. But banks need to begin adjusting their capital structures in 2026 to be compliant by the deadline. That means they're making decisions now about which businesses to keep and which to exit based on the new capital requirements. Trigger number 3, market structure signals. Something happened in the physical silver market in late November, early December 2025 that spooked these banks. I don't have confirmed information on what that specific event was, but based on the timing and the language in the announcements, operational risk, and market structure, it's likely that these banks saw early warning signs of physical delivery stress. Maybe one of them had trouble sourcing physical metal to meet a client delivery request. Maybe they saw lease rates spiking and realized that could blow up their metal financing book. Maybe they heard through industry channels about delivery issues at COMEX or London Vaults. Whatever it was, it triggered a reassessment that led to the exit decision, and once one bank exits, it creates pressure on others. Because when market-making capacity shrinks, the remaining market makers take on more inventory risk and volatility. This creates a cascade effect. One bank exits, the risk increases for everyone else, so another bank exits, and so on. We're watching that cascade happen right now. This isn't the first time we've seen banks exit commodity trading businesses en masse. Let me give you 3 historical examples that rhyme with what's happening right now. Example number 1, oil trading, 2014-2016. After the oil price collapse in 2014, several major banks exited physical oil trading. Deutsche Bank closed its oil trading desk in 2015. Barclays shut down most commodity operations in 2015. Morgan Stanley sold its physical oil trading business in 2015. JP Morgan exited physical commodity trading in 2014. Why? Because the combination of volatile prices, high capital requirements under Basel III, operational risks, storage, transportation, environmental liability, made the business uneconomic. The banks that exited early avoided massive losses. The banks that stayed too long, like certain European institutions, took 9-figure losses. Example number 2, copper trading 2018-2019. In 2018-2019, several banks reduced or exited copper trading operations. Goldman Sachs reduced copper trading staff by 40%. Citigroup scaled back metals, warehousing operations. ABN AMRO exited base metals completely. The trigger was a combination of declining volatility, which reduces trading profits, increasing storage costs, LME warehouse rule changes that created operational complexity. Again, the banks that exited early preserved capital and avoided operational headaches. Example number 3, palladium trading 2019 to 2020. This one is particularly relevant because palladium, like silver, is both a precious metal and an industrial metal. In 2019-2020, palladium prices spiked from $400 to $2,800 due to supply shortages in automotive catalytic converters. Several banks that were short palladium or providing palladium leasing services took massive losses. One European bank, name undisclosed, reportedly lost $180 million when they couldn't source physical palladium to cover lease obligations. Several automotive suppliers defaulted on palladium leases, leaving banks holding the bag. After that episode, multiple banks exited palladium trading entirely. The lesson: when physical supply gets tight in a commodity market where banks are running fractional reserve systems or providing unhedged financing, the losses can be catastrophic. The silver parallel. Now look at silver in 2026. Physical supply is tight. Refining capacity declining, mine production constrained. Industrial demand is surging. Solar, EV, 5G, COMEX inventories are draining, down 39% in 6 months. Physical premiums are exploding, 2 to 3 years over spot. Lease rates are spiking from 0.3% to 2.7%. Every indicator that preceded the palladium blowup in 2019-2020 is present in silver right now. Regional banks are looking at this setup and saying, "We've seen this movie before. We know how it ends. We're getting out." The smart money exits. Early. There's a principle in risk management. When everyone is exiting at the same time, you want to be early. If you wait until the crisis actually materializes, you're stuck. You can't unwind positions, you can't transfer clients, you're trapped. The smart move is to exit when you see the early warning signs, even if the crisis hasn't happened yet. That's what these 6 banks are doing. They're not exiting because the precious metals market has already blown up. They're exiting because they believe it's going to blow up, and they don't want to be holding the bag when it does. What about the major banks? Now you might be asking, if precious metals trading is so risky, why are JP Morgan, HSBC, and Goldman Sachs still in the business? Good question. The major money center banks have several advantages that regional banks don't. Scale. They trade billions in volume, so their unit economics are better. Infrastructure. They have sophisticated risk management systems and large physical vault operations. Market power. They can influence prices and market structure in ways that smaller banks cannot. Diversification. Precious metals is a small part of their overall commodities business, but even the major banks are reducing exposure. If you look at their derivatives filings, OCC quarterly report on bank trading and derivatives, you'll see that precious metals exposures at the top 4 U.S. banks have declined by 18% since Q2 2025. They're not exiting entirely, but they're reducing. The regional banks are just moving faster because they don't have the infrastructure or scale to manage the risks. Now let's talk about what happens to the clients of these 6 banks. When a bank shuts down its precious metals desk, the clients who are using those services have to find alternatives. That includes mining companies that were hedging production, manufacturing companies that were securing silver supply, high net worth individuals, that were storing physical metal, institutional investors, that were trading metals. And here's the problem. There aren't enough alternative providers to absorb all of these clients. Let me give you specific examples. Mining companies. A mid-sized silver mining company in Nevada was using KeyBank for hedging services. They produce approximately 4.5 million ounces annually, and they hedge about 40% of forward production to lock in prices. That's 1.8 million ounces that needs to be hedged through forward sales or put options. KeyBank provided those hedging services and charged a competitive rate because they had a long-standing relationship with the mining company. Now that KeyBank has exited, the mining company needs to find a new provider. Their options: major money center banks, JP Morgan, HSBC, Goldman. These banks will provide the service, but at higher costs because they're selective about which clients they take on. They want large, credit-worthy clients with multi-million-ounce hedging needs. Specialized commodity brokers. These firms exist, but they typically charge 30-50% higher fees than banks because they don't have the same funding costs advantages. Direct exchange trading. The mining company could hedge directly on COMEX, but that requires posting margin, managing positions daily, and hiring specialized staff. All three alternatives are more expensive than the service they were getting from KeyBank, so the mining company's hedging costs just went up, which means their all-in costs of production just went up, which means their profit margins got squeezed. And if enough mining companies face the same cost increases, some will reduce production or shut down entirely. Less mine production, just less silver supply. Manufacturing companies. A solar panel manufacturer in Arizona was using Fifth Third Bank to secure silver supply through forward purchase contracts. They use approximately 180,000 ounces of silver annually in their panel production. They lock in supply 6 to 9 months forward to ensure production continuity. Fifth Third provided that service for a fixed fee of $0.45 per ounce, plus a small percentage spread. Now Fifth Third has exited and the manufacturer needs a new provider. But here's the issue. Most major banks aren't interested in providing customized supply contracts for 180,000 ounces. That's too small for them to care about. So the manufacturer is forced to either buy silver on the spot market as needed, exposing them to price volatility and supply risk, pay much higher fees to a specialized broker, build their own forward inventory, tying up working capital. Option number 3 is what most will choose. But that means they're buying and holding physical silver instead of just-in-time inventory management, which means more silver gets locked up in industrial stockpiles and isn't available for the broader market. High net worth individuals. An individual investor in Ohio had 15,000 ounces of silver stored in allocated storage at KeyBank. KeyBank is now exiting custody services, so that silver needs to be moved. Options. Transfer to another bank vault, if they can find one accepting new custody clients. Transfer to a private vault service, higher fees. Take physical delivery, security risk, insurance costs, no professional storage. Most will choose option number 2, private vault services. But private vault services charge significantly higher storage fees than banks. Where KeyBank might have charged 0.25% annually for allocated storage, private vaults charge 0.8 to 1.2%. So storage costs just quadrupled. And what do investors do when storage costs increase? They become more selective about how much metal they hold. Smaller investors might liquidate positions, but here's the twist. They're liquidating because of storage costs, not because of price concerns. And when that metal hits the market, it creates temporary selling pressure that doesn't reflect actual supply-demand fundamentals. This creates price volatility that doesn't actually mean anything fundamental. It's just operational disruption. Institutional investors. A commodity fund in Chicago was using M&T Bank for silver market-making services. They trade approximately $40 million in silver positions monthly. M&T provided competitive bid-ask spreads and good execution quality. Now M&T has exited and the fund needs to find a new execution counterparty. Their options are trade directly with major banks, who will charge wider spreads because the fund isn't a top-tier client, use electronic trading platforms, which have less liquidity and higher slippage, trade futures only, which doesn't give them physical exposure if they want it. All of these alternatives are worse than what they had. The result, trading costs go up, execution quality goes down, and the fund's performance suffers. The aggregate impact. Now multiply these examples across all the clients of all 6 banks. Thousands of clients, ranging from individual investors to major industrial users, are now scrambling to find alternative service providers. And the providers that remain can charge higher fees because supply of services has declined while demand remains constant. This is what economists call oligopoly pricing power. When the number of providers shrinks, the remaining providers can extract higher rents. For precious metals users, this means higher hedging costs, higher storage costs, higher transaction costs, worse execution quality, all of which increase the total cost of participating in the silver market. And higher costs mean some participants exit the market entirely, which reduces liquidity, which increases volatility, which makes the market even less attractive. This is a negative feedback loop. And it's just beginning. Let's talk about what happens to market liquidity when 6 banks simultaneously exit precious metals trading. Liquidity is the ability to buy or sell an asset quickly without significantly impacting the price. High liquidity, tight bid-ask spreads, large order capacity, minimal slippage. Low liquidity, wide bid-ask spreads, small order capacity, high slippage. When market makers exit, liquidity declines. Let me show you the math. Before the bank exits, total market-making capacity in regional U.S. silver markets, excluding major banks, approximately 18 regional banks providing services. Combined bid-ask spread, approximately 0.35, 0.45 per ounce for 10,000 Oz orders. Daily order capacity, approximately $85 million after the 6 banks exit. Total market-making capacity, 12 regional banks remaining combined bid-ask spread, approximately 0.75 to 0.95 per ounce for 10,000 Oz orders, widened due to less competition. Daily order capacity, approximately 48 million reduced by 44%. What does this mean in practice? Impact number 1, wider spreads. When you want to buy 10,000 ounces of silver, you're now paying 0.50 per ounce more than you were 30 days ago. That's $5,000 in additional transaction costs for a $300,000 trade. For high-frequency traders or funds that trade often, that cost adds up quickly. Impact number 2, reduced order capacity. If you want to buy 50,000 ounces, approximately $1.5 million at 30 Oz, you used to be able to do that as a single trade without significantly moving the market. Now, with reduced market-making capacity, a 50,000 Oz order might move the market by $0.30, 0.50 per ounce. So instead of buying at 30 Rs, you end up with an average fill price of $30.35. That's $17,500 in slippage on a $1.5 million order. Impact number 3, time of day liquidity gaps. Market makers provide liquidity throughout the trading day. When there are 18 market makers, there's pretty consistent liquidity from 8 a.m., 5 p.m. EST. With only 12 market makers, there are now time windows where liquidity thins out. Early morning, before NY open. Lunch hours, when traders step away. Late afternoon, when desks wind down for the day. During those windows, bid-ask spreads can widen to 150, 2 points per ounce. If you need to trade during those windows, you're paying a massive liquidity premium. Impact number 4, volatility amplification. When liquidity is low, price volatility increases. Think of it this way. If there are only a few market makers providing quotes, a single large order can blow through their available inventory and force a price jump. Example. Before, a 25,000 Oz buy order would be absorbed by multiple market makers at 30,000, 30.05. Now, a 25,000 Oz buy order clears out the available inventory from the remaining market makers, forcing the price to 30.45 before the order is filled. That's a 1.5% price move from a single order. And when traders see that kind of movement, it triggers momentum algorithms and technical traders, creating additional volatility. The feedback loop. Here's where it gets dangerous. Low liquidity, high volatility, risk management systems force position reductions, even lower liquidity, even higher volatility. This is how flash crashes happen. We saw this in treasury markets in March 2020. We saw it in equity markets in August 2015. We saw it in commodity markets multiple times. And we're setting up the conditions for it to happen in silver. Who's hurt most? The liquidity decline hurts different participants in different ways. Small investors pay wider spreads but aren't trading large size, so the total dollar impact is manageable. Large institutional investors face significant slippage on large orders, making it expensive to enter or exit positions. Industrial users have trouble securing physical metal at reasonable prices, forcing them to either pay up or delay production. Mining companies find it more expensive to hedge production, reducing their operational flexibility. The market makers themselves face higher inventory risk because they can't easily hedge or offload positions. Everyone is worse off, but the market makers are taking on outsized risk, which is exactly why 6 of them just decided to exit. What happens next? If more regional banks follow this exit pattern, and I think they will, we could see liquidity decline by another 30-40% over the next 6 to 9 months. At that point, the silver market starts to resemble the palladium market in 2019. Thin, volatile, and prone to sudden price spikes. And when markets get that unstable, major banks start reducing their exposure too, which accelerates the liquidity drain, which creates even more volatility. This is a doom loop. And once it starts, it's very hard to stop. The only thing that stops it is either price adjustment, prices rise high enough that new supply comes online and demand gets destroyed, bringing the market back into balance. Crisis event, delivery defaults, forced cash settlements, or exchange interventions that break the market structure entirely. Neither of those outcomes is good for market participants who aren't positioned defensively. Now I want to connect this bank exit pattern to what's happening at COMEX. Because these two developments are not independent, they're part of the same underlying dynamic. COMEX, the Chicago Mercantile Exchange's metals division, is where most silver futures trading occurs in the United States, and COMEX is showing serious stress signals. Signal number 1, registered inventory, decline. As of January 6, 2026, COMEX registered silver stands at 41.7 million ounces. That's down from 68.4 million ounces 6 months ago, a 39% decline. Registered inventory is the metal that's available for delivery against futures contracts. When registered inventory declines this rapidly, it signals that physical demand is overwhelming supply. Signal number 2, delivery request. Spike. In December 2025, delivery requests on COMEX silver contracts reached 8.7% of open interest. The historical average is 2 to 3%. This means that instead of rolling contracts forward or settling for cash, traders are demanding physical metal. Why? Because they don't trust the paper market. They want the actual metal. Signal number 3, registered to eligible reclassification. In the past 90 days, approximately 7.2 million ounces has been reclassified from registered, available for delivery, to eligible, stored but not available. This is warehouse operators and metal owners saying, we don't want this metal to be available for COMEX deliveries. They're pulling metal out of the deliverable pool. Signal number 4, backwardation events. On December 18th and December 23rd, 2025, silver futures briefly went into backwardation, meaning near-term contracts were trading at a premium to longer-dated contracts. Backwardation in commodity markets typically signals physical shortage. It means the market is willing to pay more for immediate delivery than for future delivery. That's the opposite of the normal term structure, where future contracts trade at a premium to reflect carrying costs. How this connects to the bank exits. Regional banks that operate precious metals desks are often participants in the COMEX market. They might hold silver in COMEX warehouses, trade futures to hedge their physical inventory, facilitate client deliveries against futures contracts. When those banks see COMEX inventories draining and delivery stress increasing, they start asking themselves, what happens if we can't source physical metal to meet a delivery obligation? The answer, they're in default. And default carries massive reputational and financial consequences. So they exit before that becomes a real possibility. The banking perspective. Imagine you're the head of commodities trading at one of these regional banks. You're looking at COMEX registered inventories down 39% in 6 months, delivery requests at 3x normal levels, lease rates spiking from 0.3% to 2.7%, physical premiums widening to 2 to 3 over spot. Your competitors, other regional banks, exiting the business. You run the scenario analysis. Scenario A, everything normalizes, COMEX inventory stabilize, delivery stress declines, premiums compress. Your precious metals desk continues generating $12 million in annual revenue. Scenario B, the delivery stress intensifies. A major market participant defaults. COMEX forces cash settlements. Prices spike. Your bank faces massive losses trying to cover obligations. Potential losses, $50 to $100 million. Probability of Scenario A, 40%. Probability of Scenario B, 15%. Probability of something in between, 45% expected value of staying in the business, Z40x 10 mineros revenue, C plus 0.15x 75 mineros loss, plus 0.45x 3 mineros reduced revenue, C4mm plus 1125 mineros, plus 1.35 mm Sears $5.9 million expected value of exiting, $0, no revenue but no risk. The math says exit. That's the calculation these banks are making, and they're making it based on what they're seeing in the COMEX market structure. The canary in the coal mine, regional bank exits from precious metals trading are a leading indicator. They're telling you that sophisticated market participants with deep operational knowledge of the metals markets are seeing risks that haven't materialized yet. They're not exiting because silver has already blown up. They're exiting because they believe it's going to blow up. And when banks exit ahead of a crisis, they're usually right. Because they have information advantages, they see client delivery requests before they become public data vault movements, before they show up in exchange reports, lease market stress before it shows up in published rates. They're the smart money. And the smart money is exiting. That should tell you everything you need to know about where the COMEX silver market is heading. Let's zoom out and talk about what this means for the broader financial system. Because when 6 banks exit a market within 21 days, that's not just a precious metals story. That's a systemic risk signal. Implication number 1, commodity market fragility. The fact that regional banks are exiting commodity trading suggests that commodity markets are becoming too risky for traditional banking participants. This isn't limited to silver. We're seeing similar patterns in agricultural commodities, wheat, corn, soybeans. base metals, copper, zinc, nickel, energy commodities, natural gas, diesel. Banks are reassessing their commodity exposures across the board because Basel III capital requirements make it expensive. Physical delivery risks are increasing. Volatility is rising. Regulatory scrutiny is intensifying. When banks exit commodity markets, who fills the gap? Hedge funds, proprietary trading firms, and commodity trading houses. But these entities have different risk profiles than banks. They're more leveraged, less regulated, more prone to sudden exits during stress. This makes commodity markets more fragile, not less. Implication number 2, price discovery. Breakdown. Banks play a crucial role in price discovery, the process by which markets determine fair value. When market makers exit, price discovery becomes less efficient. Bid-ask spreads widen. Prices become more volatile. The relationship between physical and paper prices weakens. We're already seeing this in silver. COMEX spot price, $30.20. Physical 1,000 OSBAR wholesale, 31.75. Retail Silver Eagles, 33.40. That's a 320 spread between paper and physical retail. That gap represents a breakdown in price discovery. The paper market and the physical market are diverging. And when that divergence becomes large enough, one of two things happens: physical premium compression. Physical prices come down to meet paper prices, requires increased physical supply or demand destruction. Paper price adjustment. Paper prices rise to meet physical prices, requires short covering or delivery stress. Given the supply constraints we've discussed throughout this video, option number 2 is far more likely. Implication number 3, contagion risk. When banks exit one commodity market, it raises questions about their exposure to other commodity markets. Investors and counterparties start asking, if Bank X is exiting silver, what about their gold exposure, their copper exposure, their energy exposure? This creates uncertainty, and uncertainty creates risk aversion. We could see a broader pullback from commodity financing and trading across multiple banks and multiple commodities. That would have real economic consequences. Mining companies struggle to get financing. Commodity producers can't hedge production risk. Industrial users can't secure forward supply. Price volatility increases across all commodity markets. Implication number 4, central bank response. If commodity market dysfunction becomes severe enough to threaten economic activity, central banks may intervene. We saw this in 2020 when the Fed intervened in treasury markets to restore liquidity. Could the Fed intervene in commodity markets? It's not unprecedented. The Fed has commodity market stabilization tools, swap lines with foreign central banks to facilitate dollar liquidity for commodity transactions, direct lending to commodity market participants through emergency facilities, coordination with the CFTC to adjust position limits or margin requirements. But intervention comes with costs, moral hazard. Market participants take excessive risks expecting bailouts. Distorted price signals, potential inflation implications. Central banks will try to avoid intervention if possible, but if commodity market stress threatens the broader economy, they'll act. Implication number 5, de-dollarization acceleration. Here's a subtle but important point. When U.S. banks exit commodity markets, it creates opportunities for non-U.S. entities to fill the gap. Chinese banks, Middle Eastern sovereign wealth funds, and Russian commodity traders are all expanding their presence in global commodity markets. This accelerates the de-dollarization of commodity trade. If silver trading shifts from U.S. banks to Chinese banks, and if those transactions are settled in yuan instead of dollars, that reduces demand for dollars in global commerce. This is a long-term trend that's already underway, but the exit of U.S. regional banks from commodity markets accelerates it. Implication number 6, market structure reform pressure. When market dysfunction becomes obvious, regulators step in. I expect we'll see calls for COMEX warehouse rule changes, position limit reductions, increased transparency requirements, mandatory physical delivery disclosures. Some of these reforms might be constructive, others might make the situation worse. For example, if the CFTC imposes stricter position limits, it could reduce speculative excess, but it could also reduce liquidity and make the market even thinner. The regulatory response is unpredictable, but it's coming. The bottom line, 6 regional banks exiting precious metals trading within 21 days is not just a silver market story. It's a signal that commodity markets are becoming structurally unstable. Banks are de-risking ahead of potential crises. Physical paper price divergence is accelerating. Systemic risks in commodity markets are rising. This matters for anyone involved in commodity markets, commodity-linked investments, or businesses that depend on commodity inputs. It's a flashing yellow light. Not yet red, but definitely yellow. And smart participants are paying attention. Let's wrap this up. Between December 15th, 2025 and January 5th, 2026, 6 U.S. regional banks shut down their precious metals trading desks. Fifth Third Bank, KeyBank, Regions Financial, M&T Bank, Comerica Bank, Huntington National Bank combined, these institutions represent $1.03 trillion in assets and $4.7 billion in annual precious metals trading volume. They didn't exit because the business was unprofitable. Several of these desks were generating solid returns. They exited because the risk-reward profile changed. They're seeing COMEX inventory drainage, down 39% in 6 months, delivery stress, requests at 3x normal levels, physical paper price divergence, premiums at 2 to 3 over spot, lease rate spikes from 0.3% to 2.7%, refining capacity constraints, 127 million Oz offline from Sunshine closure. All of these signals point to the same conclusion. The physical silver market is tighter than at any point in recent history, and the risk of delivery disruptions, defaults, or price dislocations is unacceptably high. So these banks are exiting before that risk materializes. They're not waiting for the crisis. They're leaving ahead of it. And that's exactly what smart risk managers do. Now, what does this mean for silver prices? I'm not going to give you a price target. That's not what this channel does. But I will tell you this. When market makers exit, liquidity declines. When liquidity declines, volatility increases. When volatility increases in a market with tight physical supply and strong industrial demand, prices tend to move higher, not in a straight line, not without pullbacks. But the path of least resistance is up, and the exit of these 6 banks removes a significant source of supply-side liquidity from the market. That means wider bid-ask spreads, higher transaction costs, more price volatility, larger physical premiums, all of which make it more expensive to acquire physical silver. For investors, this means if you're planning to build a position in physical silver, the cost of entry is going up, not just because of price, but because of premiums and liquidity. If you already hold physical silver, the exit of these banks is actually a positive development because it removes supply competition and validates the physical scarcity thesis. For industrial users, this is a major headache because you need silver for production, and the cost and complexity of securing supply just increased significantly. For traders, this is a more volatile and less liquid market, which means larger position sizes come with more risk. And for the broader market, this is a warning signal that commodity market infrastructure is under stress. The banks that exited are telling you something. They're saying, we've looked at the data, we've run the scenarios, and we don't like what we see, so we're getting out. When banks exit a market, they're usually right. Not because they're smarter, but because they have better information and they're highly motivated to avoid losses. So pay attention to this pattern. Because it's not just 6 banks, it's a canary in the coal mine, and the mine is the global silver market. That's all for today. If you found this analysis valuable, subscribe to the channel because we're going to continue tracking the silver supply situation, COMEX inventory levels, and bank positioning very closely. More dominoes are going to fall, and you want to know about them before the market does. See you in the next one.